Welcome to the 2017 third quarter investment call with the San Diego Foundation. Thank you for joining us today. Quarterly investment calls are an enhanced service to donors. The calls provide direct access to our investment leaders in a consistent, convenient, concise format so donors can remain informed about the performance of their charitable assets. Leading today's discussion will be Steve Klosterman and Matt Fettig. Steve Klosterman is Regional Director at Harlbert Hargrove and serves as Investment Chair for the San Diego Foundation Board of Governors. Steve advises a wide range of individual and institutional clients and began his investment management career more than 35 years ago building his own investment advisory business. Steve is past chair of the UCLA Foundation and a founding board member of the UCLA Investment Company, which oversees a $2 billion endowment. As Chief Investment Officer for the San Diego Foundation, Matt Fettig oversees and manages our investment strategies and activities. This includes working with the Board Investment Committee, senior staff, auditors, professional volunteers, fund managers, and outside consultants to establish, maintain, administer, and monitor policies related to foundation investments. Today, Steve and Matt will start the call with a brief macroeconomic update followed by performance and attribution reports for our endowment portfolio and our long-term, medium-term, and short-term portfolios. We'll conclude with a question and answer session. To submit questions, please use the questions chat function located on the webinar sidebar menu anytime throughout the call. Any questions unanswered today will be answered via email. Attendees can access slides and a recording of today's call on our website at sdfoundation.org by tomorrow. Now, Steve will get us started.
Thank you, Teresa, and thank you for listening in today. We appreciate your support of the San Diego Foundation. I'm proud to be a board member here and serve as the chair of the investment committee and work closely with Matt, who you will hear from in just a few moments. I'd like to start with the first slide, which shows the relationship between PE expansion and earnings growth here in 2017. We're in the 9th year of an economic expansion here in the U.S., and as you're probably aware, we've had 9 positive years in the S&P 500, counting this year. And with abnormally low interest rates in the U.S. and the globe, we have seen price earnings multiples expanded, and the U.S. market is comparatively expensive. However, this year you can see that the market is very much driven by earnings growth, particularly starting back in April. In other words, the green part of the graph represents that earnings growth. So if we would go on to the next graph, we'll look at valuations. And there's various methods of evaluating where stocks are and whether they're expensive or relatively inexpensive. Here are some of those metrics. You have the price to book value, and we're comparing, if you notice, 3 different markets: the international developed markets, which is EFI, United States, and then the green is the emerging markets. And in every one of the metrics, the comparisons are favorable in terms of the developed international and the emerging markets. Those metrics are, again, price to book value, price earnings ratio, price to free cash flow, your dividend yield, and your earnings yield. This has benefited us because we have a tilt to the international markets, and part of that is based on these attractive valuations. We'll move to the next slide. This has to do with the Federal Reserve rate hike expectations. You may be aware that the Fed is meeting today, and there'll be an announcement about rates tomorrow. The expectation is that there'll be a 25 basis point increase, or 0.25%. And what you see on this graph is the Fed dot plot, which is their forecast for interest rates, but then the market expectations, which you can see are lower. And the reason that the market expectations are lower, or certainly one of the reasons, is that unemployment is low, and we have disinflationary forces that are keeping the rates low and keeping the Fed from hitting its 2% inflation target. One of those things has to do with imports. In effect, when those imports come to the U.S., they are basically exporting deflation. They're helping keep inflation down by having goods be cheap. And we're about a 65 to 70% consumer-driven economy, so that's a key factor. We also, with the low interest rate policy, that's been supported by the economic expansion. It helps keep that expansion going with low interest rates. It helps stimulate the economy. So with that, I'm going to turn it over to Matt, and he'll comment specifically on our portfolio. Thank you.
Thanks, Steve. And before we get going on the next slide, I just want to thank Steve for joining us today. If you've been a regular listener of these calls, you know Horacio Valeris had been previously the chair of the investment committee here. Horacio was kind enough to serve not only one term as chair, but essentially 2 terms. He remains on the investment committee, and we are just thrilled to have Steve and his leadership here with us today and helping guide the San Diego Foundation for the next few years. So again, thank you, Steve. Let's go on here and let's talk about investment results for the third quarter. The third quarter, the endowment portfolio, as you can see here on the page, was up 3.7%. We were slightly behind our policy index, but I just want to give you a sense of how good these results actually are. I always refer to our peer group ranking, or how well we do relative to a set of like-minded nonprofit peers. And our 3.7% for the quarter ranked in the 19th percentile, 1 being best. So despite trailing just a bit for the quarter, results were actually quite strong. You can see on the year-to-date basis, January 1st through September 30th, we're in line with our policy index, up double digits, and over the 1-year period, we're ahead of our policy index in ranking in the 31st percentile. So we have had relatively strong results, both relative and absolute, over the course of the last several years, and that has continued to allow us to exceed our policy index over longer periods of time, in line over that 10-year period. So what is driving results? Steve really hit the nail on the head. Our positioning in the equity markets has been very favorable. Number one, we've had a relative overweight to emerging markets. Emerging markets have been one of the strongest drivers of performance, both for the quarter and the year-to-date period. We have been a relatively overweight non-U.S. developed stocks, and those have also been relatively strong, followed by the performance of the U.S. markets, which, as you all know, has been strong. But if you line these up in terms of what's outperformed the other, emerging markets has done best, followed by non-U.S. developed markets, then the S&P 500 or the U.S. market. So we are seeing great benefit to our positioning. If you remember 2 years ago, we were underperforming because we had this overweight to the non-U.S. markets. That has turned around, and our portfolio performance reflects that. Our fixed income portfolio has actually been a bit of a driver in terms of our performance versus the policy index. Over the last year, we're almost double the performance of our index in fixed income. And so we have certainly benefited from some of the positioning that we have had there. Other areas, the alternatives portion of our portfolio, as you can see, at 19.8% as the end of September. I just want to give a refresher. Remember, about half of this is hedge funds. Hedge funds are really designed to mitigate volatility, particularly if we do have a market correction. And the other half of that alternatives exposure is private investments. And just a word on our private investment portfolio. We continue to build out that portfolio, and I'll tell you that over the course of the last quarter, year to date, and 1 year, those privates have been a drag on our performance. Our performance would actually be a bit better. But these are long-term investments we are allocating to, and we expect them to produce a premium to the public market's return. So we're making an investment now, and in the short term it's hurt us a bit, but we would expect these investments over time to continue to be a strong driver of returns. So with that, let's move on and let's look at the long-term pool. Long-term pool has had very strong results for the quarter, the year-to-date period, and the 1-year period. A lot of this was driven by the same factors that we've already talked about: overweight to emerging markets, overweight to non-U.S. developed stocks, and of course the U.S. stock market has helped us quite a bit as well. Few other drivers. Commodities have been a driver. Remember, we had a large correction in commodities a couple years ago, and certainly that was a source of pain for this portfolio. Over the last year, that has turned around quite a bit, and our commodities exposure, not only has it been positive, but we have managed to outperform our commodity index by a fairly healthy margin. Other sources of return here include, over a 1-year period, our fixed income exposure. That has certainly helped us. We've had allocations to fixed income such as high yield or junk bonds, to the emerging markets, and all of those areas have been additive. I will say, come February at our next investment committee meeting, we'll be taking a look at asset allocation, and I think there's a question out there as to whether how additive some of these areas may be in the future if we are indeed late in an economic cycle. Going forward here, we'll move to the medium-term pool. The medium-term pool has also experienced strong results here for the quarter, the year-to-date period, and as you can see over the last year, up 7.2%. I will just say that these are strong results for this pool. I wouldn't expect a 7.2% consistently going forward out of this pool. This may be one of the better returns for an annual period that we have. The reason being, we're only about 30% invested in the stock market in this portfolio. The rest is in bonds and commodities and cash, as you can see. So I'd say we've exceeded our expectations here in the short term. A lot of that being driven, number one, again, by our fixed income. We've managed to outperform our fixed income index, and then also that same positioning in the equity area that we've had in the other portfolios. Next slide. So maybe I'll spend a little bit more time than I normally do on the short-term pool, as you can see here. Remember, this is a portfolio that takes basically no risk. It's invested in money market funds. Money market funds are extremely short-duration fixed income instruments, and a lot of this is invested in U.S. Treasuries. For a period of time when interest rates were as low as they were, we were essentially getting no yield or return out of this portfolio. But as the Federal Reserve continues to increase rates, we have seen some yield come back, and we are producing a positive rate of return in this pool. Should the Fed, as expected, increase interest rates again tomorrow by 25 basis points or 1/4%, again, we're going to continue to see performance ratchet up. That said, it's hard to get excited about a sub 1% return, but there is some yield here in the event that you're looking to keep your charitable dollars very safe. So that concludes my remarks. I think what we'll do at this point is we will open it up to questions. And I think there's one thing I'd like to address. So if you would like to ask a question, you can submit a question through the question and answer panel on your screen. And while we wait for questions to come in, I want to quickly talk about and give a reminder about deadlines for year-end giving. So as we reach the end of the calendar year, I am going to provide you with the following deadlines. So for stock donations, if you'd like to make a stock donation to the San Diego Foundation, it must arrive in our brokerage account no later than December 22nd at noon. December 22nd at noon for stock donations. For any credit card donations, the cutoff period will be December 29th at noon. That's December 29th at noon. For cash donations must be hand-delivered to our Liberty Station office no later than December 30th at 1 p.m. And finally, check donations must be postmarked on or before December 30th. So if you have any questions or missed any of that, feel free to get in contact with your donor manager here at the San Diego Foundation. We have a question here. I will ask the question and let Steve answer. First question, would continued growth in Europe and emerging markets benefit the San Diego Foundation's endowment and long-term portfolio investment approach?
Yes, it would. And the reason is, again, we have a tilt to both those markets based on attractive valuations and growth prospects. In aggregate, the emerging markets have GDP growth expected to be about double the U.S. So it definitely would help us, particularly if you factor in that U.S. companies, particularly our large multinational companies, do a lot of business with those emerging market countries. It could be a double win. We could benefit from our tilts to those markets, plus the U.S. markets could continue to do well. But I can tell you that our consultants, and this is consistent with other environments I'm in, the highest expected return going forward, emphasis expected, is on emerging market equities. So yes, it would definitely benefit us.
Thanks, Steve. Appreciate that. Next question, how might the anticipated Federal Reserve rate hikes affect the San Diego Foundation's strategies? For example, percentage of assets allocated to bonds. I'm happy to take that one. And we kind of talked about this already, but John, I'm going to ask you if you could go back to the endowment portfolio page so we can use this as an example. So you see here on the endowment portfolio page what our allocation of fixed income looks like in the endowment. Fixed income at 9.9% on the domestic side and 6.9% on the global and international side. I would argue that is a relatively low allocation to fixed income to begin with. And over the course of the last several years, it is true that the investment committee has been lowering the allocation to fixed income in anticipation of what could be an increase in interest rates. So remember, fixed income has an inverse relationship with interest rates. As interest rates go up, bond prices go down. And based on Steve's comments on the Fed rate hike expectation page, while the Federal Reserve expects what I'd call fairly steady but slow interest rate hikes over the course of the next year or two, market expectations have not been as strong. And that has been on this inflation issue, the fact that we have not met the Fed's target on inflation. So I think the biggest risk we have here in this portfolio to our fixed income allocation is if interest rates were to unexpectedly rise faster than either the Fed anticipates and certainly than the market anticipates. That said, I would go back to my original argument. We have very little invested in the fixed income market right now because bond prices are so high and we see very little upside. So I don't know that our weighting to fixed income would change dramatically from where it is now. Certainly the makeup of the fixed income portfolio could change, and I think that's something we might be talking about here at our next meeting in February. Well, with that, we have no further questions, so I'll turn it back to Teresa.
Thank you, Matt, and thank you, Steve. And thank you to everyone for joining us today and partnering with the San Diego Foundation to maximize the impact of your charitable giving. Today's presentation will be available by end of day tomorrow on our website at sdfoundation.org/investments. We look forward to seeing you at our annual investment summit on Thursday, February 15th from noon to 2. Please mark your calendars and have a happy holiday.